Good morning, I'm Vince, and this is the Gold Fix. We have a lot to discuss today, so let's get to it. On your screen is the Gold Fix homepage. There are three stories there. There are two of which I'd like to direct your attention to. On the left, yesterday, Arizona announced that they would be passing a bill regarding the storage and use of gold as a transactional asset. And Druckenmiller, his Duquesne fund, buys Barrick and Newmont. We're going to discuss those quickly, and I'll give you links to more information on them. The third story in the middle featured there is on topic of the monetary BRICS solution. That was a founder's post. I've unlocked it for everyone to use. So let's start with the stories. All right, yesterday, the Arizona Senate committee passed a bill to establish a bullion depository and transactional gold-backed currency. On Monday, an Arizona Senate committee passed a bill that would establish a specie-backed transactional currency and a state bullion depository. Quick comment on what that is. That's basically like what the BRICS are doing. They're going to facilitate the use of gold and silver in transactions, much like people are doing with Bitcoin at Starbucks, for example. So gold is money, silver is money. We'll get more into that. There are some, I'm going to cover this more, but I'm going to send you the link to that for now. So you'll have this whole story. Second story. Druckenmiller's Duquesne drops Alibaba and Amazon, picks up Barrick Gold and Newmont. Now, this is significant. Duquesne Family Office, the investment vehicle belonging to famed macro investor Stanley Druckenmiller, dumped shares of Alphabet, Amazon, and Broadcom, while scooping up shares of beaten-down gold miners Barrick and Newmont. Note, he's selling tech and he's buying miners. Now, this is another thing that I'm happy to comment on, but let's just start with this. It's good news, okay? That's it. It's good news. All right, where are we? Here we are. So this is the post we're working on now that we're recording for. As you can see, Druckenmiller buys Barrick and Newmont. Arizona goes gold. Michael Oliver looks at miners. We're going to touch on that next. The links to these two articles that you just saw on the screen are in the bottom, so it's one-stop shopping for this post. All right, current prices first. The dollar is down 16. Bonds are down. Bond yields are down 4. Stocks are up 8.5 handles. The VIX is slightly softer. Gold is up 550. Very significant. I'll explain why in a little bit. Silver's up 29 cents. Good. Platinum and palladium are both up. Palladium, who knows why? We all pretend we know why, but no one really knows. Copper is up 55 basis points. Gold-silver ratio continues to back off in an orderly fashion. Crude is down 40. Natural gas is unchanged, up 2 cents. Bitcoin up again, almost a percentage point, 500 points. Ethereum tracking it, but weaker than Bitcoin. Grains are both up a little bit. Okay, yesterday's activity. Just to give you a quick feel for yesterday's activity, yesterday's gold fix, I made the point of saying it doesn't look good. But you want to see this market consolidate in the 2000 area. And I described how once it gets to 2000, if it holds in that area, you're going to see options volatility, options open interest dictate price flow, and that will give it a level to base. People like to refer to options as being something that keeps the market down. Well, in this case, it is definitely keeping the market up. I'll explain. There's something that you'll hear me say over the years called gold hates the teens. And gold hates the teens because it hates 2015, it hates 1915, it hates 1815. It hates the teens all the way down to, I kid you not, 1,000. Why does it hate the teens? Because there's usually massive options open interest bunched up at those big round numbers. And the teens are above the strike, the 1900 strike, the 2000 strike. They are the escape velocity area. If you can't get away from If you can't get above the teens, you can't escape the gravitational pull, and that's the nature of options. Conversely, and to our benefit, that's why the market will also hover above 85. So it's 1915, 2015, okay? 1985, so it's 15 cents higher, $15 higher, $15 higher, $15 lower. In that range, the options dominate the behavior. What happened to gold yesterday? Well, it went down to 85 and it held. That's a really good sign. That means that the options are exerting influence. That means people are hedging. To get a little bit wonky here, people are hedging their gamma, and people don't want the calls to or the puts to be naked short. They want to be flat to long. That's a good sign. Now, we go down below 85 again. You want to be scared. That probably won't happen the second time. Options guys don't rebuy. They buy the first time. They don't rebuy the second time. They sell the first time. They don't resell the second time. That's why you'll see if we get to 2015, it'll hit, come off, and then if it's going to go up, it's just going to rip right through that. Anyway, enough about that, except to say yesterday's activity, although the market was lower, was very constructive. And I want you to know that the shorts that I had on in gold, I took off. The longs that I have on in gold remain, and the shorts that I have on in bonds, I took off. I had some profits I wanted to book. Okay. That's it. You've got to be. Yesterday was very constructive for gold. It's how it reacted to the sell-off that matters most. And you can thank silver for that, right? Silver is leading the way. So there's your yesterday's activity summed up. Today's data is jobless claims, retail sales, and there's more below. Retail sales could be the fly in the ointment today. I'm not really sure which way people are leaning on that. But let's just say if retail sales miss, you could see this whole FOMO thing happen again. Okay, if retail sales, that's it. Retail sales is important. All the data is important right now. All right. News. All right. Fed's Barr, he's a voter, said January data was stronger than expected for both jobs and inflation, while he added the Fed is looking at the totality of numbers and a lack of historic parallels. And that makes monetary policy decisions difficult. Okay, cutting through the bullshit. The Fed believes that January's inflation data, while bad, was temporary, and it had to do in part with January price hikes, if you want to call it that, seasonality. And it happens on occasion. And this year it happened. So they believe, and I believe Goldman thinks this as well. The Fed, I don't know what the Fed believes, but the Fed is hoping that February will come in line with the trend. So here's the trend, and there's January. It's looking for January to be the aberration and the trend to reassert itself in February. That's what they're doing. But the most important takeaway from all this is they're looking for excuses to not ease. They don't want to ease. That's it. Yesterday's chart, I'll update that later. Before we get today's game plan, there's the Druckenmiller post, and there's the Arizona post. Now, I want to talk about Michael Oliver. Now, Michael Oliver puts out a report, the MSA technical report. And yesterday, either coincidentally or fortuitously, he put out a report that we received in the mail, a brief take on Barrick and Newmont. And the headline is Finding the Upturn in Big Gold, Newmont and Barrick as Stock Market Wobbles, February 14th. Now, I'm just going to read a little excerpt from that and give you a little bit of insight or a little interpretation of his insight, I should say. And readers will be able to see more of that. All right. So he opens by saying, we've argued for months that gold and related are inverse to the stock market. Here we update the two big blue chip miners, Newmont and Barrick, which have been beaten off the page recently, certainly in relation to gold. But remember the old saying, buy low, sell high. Perhaps it's time for investors to consider the bombed out and undervalued tiny category of gold and silver miners. When the stock market wobbles and drops even marginally, bet that some large fund managers, especially the many who have said they mistrust this latest surge, will quickly reshuffle their allocations away from stocks, particularly the bubble ones, and into alternative categories such as T-bonds, gold, and gold miners, especially the blue chip miners. There's a lot we can say to that, and there's really no need to do anything. Everything he says stands well on its own. A couple things that we do want to add. Why are the miners so beaten up? That's the question you should ask yourself. Well, the risks are to further dividend cuts. Newmont cut last year, but it was seen coming. It was not a surprise. International risks as mines are being nationalized. Everyone's the whole mercantilism thing. This is our metal, you can't have it, and they're renegotiating with miners. Labor problems have been ascending in those countries, instigated by those countries. Financing has been a problem, not for the big guys, for the little guys, and as a result, the good get hammered with the bad. And there's plenty of bad miners out there. And frankly, before this happened, I was seriously looking at Newmont because their dividend is coming in around 5%. And I was looking to see what the chances were of their dividend being cut again, because that's the only thing I'm worried about. You can't let Newmont, it's big gold, right? It's big gold. It's like big oil. It's like big tobacco. Well, maybe not big tobacco. Big tech. It's big gold, right? All right. So, the other thing I wanted to mention to you is that Newmont has about a 5% dividend, which is what I've been looking at, and Barrick has around a 3% dividend. Now, the difference in dividend may be legitimate, so maybe Barrick's the better buy. I haven't looked at it closely yet. And Michael also lets us know that production costs are about $1,200 per ounce for Newmont, and production costs are around $1,350 per ounce in Barrick, which might explain the dividend difference. And he has a couple charts in there. I'm just going to show you one of them. And what he's keying on today is the price is dropping, but a proprietary momentum indicator that he uses is not dropping. So in this first sell-off, see this area here, the market makes a low, the indicator makes a low, right? The market makes low number 2. The indicator makes low number 2. The market makes a new low, the red arrow. The market makes a new low, right? The indicator makes a high, or does not make a new low, I should say. So point being that you have a divergence similar to a MACD or an RSI. It doesn't make a new low when the market does. And that's what put it on his radar. So you could, when did we had a, was it Newmont or Barrick? One of them had a gap lower in 2019. Look, Druckenmiller bought, and unless he's going to be like Buffett, renting it, I don't look. It's very good. Druckenmiller bought. That means the dividend is secure. Okay, that's my take on it. And if I want to buy gold with a dividend as opposed to stacking, which I always do, or trading futures, which I always do, then this might be a very good passive investment. If you are a gold person or a silver person, I would recommend, not recommending these companies per se, but I would recommend that a portion of your assets be in physical, a portion of your assets be in income generating physical, which would be miners, as close as you can get to it, and a portion of it be in an ETF. Now, people don't like ETFs, but for short intermediate positions, they're fine. Short term and intermediate. For long term, I'm not comfortable with them. That's for sure. He goes on to say at the very bottom, I've skipped a lot here, but he goes on to say, yes, we're monitoring gold and silver for similar upturns and also via larger metrics. But these two blue chips will no doubt be on the clipboards of asset managers when they see enough spookiness out of the stock market bubble, narrow that is. And opposite firming in gold related, and also T-bonds, TLT. MSA will be updating TLT this week for signs of a similar upturn. So you may have a whole macro cyclical change going on here. Gold and bonds, or gold miners and bonds are oversold. That's kind of, I think, what he's getting into. He throws a couple of numbers at you there, and I don't want to share them, but I'll just share them with you visually. This trend line is important, but this dotted line going across here makes it that much more important. I think that's it. Let's look at the market for a second here. All right, so what are we looking at here? Gold. Let's go to let's go to the 4-hour. Show you what I'm talking about. See this? 1985, 1986, right? Okay, gold hates the teens. Remember how I said that? Gold hates the teens. If it gets below the teens, it keeps going. Now, gold, I guess you'd say gold hates the 1985s. I don't know what they are. But below 85, it washes out. And it didn't do that. It's very encouraging. And I want to point one thing out to you from an algo point of view. See this here? That's organic behavior. See that there? That's not. Okay. This is a market that's bottoming. This is someone who caught a knife. And then this is the shorts that covered. And now a buyer is in here. Now, are they covering shorts from the sell? You have to assume yes for now. But if it snowballs into some technical level that you like, you keep going. So above 2005 in spot, you might get bullish. I won't. But I will say that above 2015, which is actually comes in. Yeah, see this 2012. If it gets below the teens, it washes. All right. So you want to look, if the market hits 2013, I'm going to buy it. It's that simple. All right. I'm Vince. This has been the Gold Fix. Oh, and let's put those back up there again. Right. So there'll be a couple cool things in here today. The first of which is an excerpt from Michael's report. The second of which is you'll have the link to the Druckenmiller story, and you'll have the Arizona bricks. I call it the brick story, the Arizona bricks, the U.S. bricks, we'll call them. But that's it. I'm Vince. Have a great day.